Good evening, everyone, and welcome to the Q3FY18 result conference call of Sintex Plastics Technology Limited. I would like to thank the management for giving us the opportunity to host this call. The management team is represented by Mr. Amit Patel, Group MD, Mr. Sameer Joshipura, Group CEO, Mr. Chetan Joshi, Joint CFO, and other senior management personnel. We'll start the call with a commentary from the management and then move into the Q&A. Thank you, everyone, and over to you, Amit, sir.
Thank you. Good evening. I would like to welcome everyone on Sintex Industries Q3 investor call. We, in Q3 this year, we had a very strong performance from retail and custom molding business. We have also seen very strong performance from our European custom molding business, and we have seen excellent growth in local automotive sector, electric sector, and internationally aerospace and defense sector. So this has been a very, very positive quarter for us. We have seen and dedicated or fixed approach on prefab business. So our approach on prefab business has been to go slow on government orders. Even government orders were quite less in Q3. We expect these orders to pick up as we come closer to election in 2019. But our focus is definitely on our balance sheet and free cash flow. And looking at that, we need to curtail our government business in prefab business. Though we have a lot of products for our private client in prefabs as well as large corporates, CSR activities, and also many products, new products we are coming out in prefab business, which will cater to government or semi-government through a retail and distribution channel rather than approaching them directly. We have also seen free cash generation in again one more quarter. Q3 we are free cash positive. We have reduced about 286 crore of debt in first 9 months. That is again as per our focus on after splitting. We had clearly two focus: reduce debt net levels as well as improve ROC. And we are focused on our goals. We want to be free cash, we want to reduce debt, and we want to concentrate on our business to business performance on benchmarking ROE and ROC. We continue to do that by reducing government business, increasing free cash, reducing our working capital cycle, reducing complete control on capex. We have been very strong capex controls put in place, and all the cash generated concentrated to reduce the debt. And this focus will continue for about at least next, I would say 2 years, 2.5 years, till the time we don't reach debt to EBITDA at about 2. By this, I would like to take questions and end my opening remarks. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their question to 2 per participants. If time permits, you may join the question queue for any follow-ups. Also, you are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Viraj Kacharia from Securities Investment Managers. Please go ahead.
Yeah, thank you for the opportunity. Just want to understand for custom molding and prefab, if you can provide the comparative figure for last year. Hello?
Yes, please go ahead.
Yeah, so if you can provide the comparative figures for custom molding and prefab business for Q3 of last year.
This is the first time, this is the first year or first 9 months we are presenting the results of SPTL post demerger. Earlier, in last year it was a combined entity with textiles business. So this is the first time we are publishing the results. So we don't have comparative last year. Those figures have been regrouped, so can't be presented. In fact,
so just want to get a sense on year-to-date basis, because if I look at sequentially, we did something around 950 crores in September, and we did something close to 1,000 crores. Now, in Q3, we're seeing that, we're seeing a record sales and margin profile in Europe business. We're seeing strong growth in auto, electric, and even in the retail side. So when I look at custom molding, both sales growth and margin-wise, the sales growth on a sequential basis has not been much, and even the margin, there's been some amount of contraction. So just want to understand,
Because there is a contraction on prefab business.
No, sir, I meant on the margin for custom molding, sir.
No, margin for custom molding is not there. See, SPTL on a consolidated basis has two divisions. One is prefab or infra business, and second is custom molding business or BAPL company. And when this quarter we had a change in mix of these two divisions. Sintex Infra degrew while custom molding business was stronger with a positive growth. Custom molding business historically has a less margin. Prefab historically always had more than 22%, 24% margins. So when prefab business degrew, overall margin looks less, but our cash generation improved. Prefab business was very difficult to collect money. On paper, it was showing higher margin, but when you see cash positiveness, working capital, receivable numbers, it was not coming. And that's why we kept on increasing debt. So that's the reason why now, though you see lesser margin, but more free cash.
Okay. So basically my question was specifically on the custom molding. So if I look at the segmental numbers which we provide, the margins which we earned in Q3 for custom molding was sequentially lower. So, we earned somewhere around 11% EBIT margin. Right now we are at 9% EBIT margin. So it was just want to understand what is the reason behind that. And second is, as you pointed on the prefab side, that we're trying to slow down that business and we're focusing more on cash generation. So going forward, what kind of scale or at what level do we see the business being more stable business, cash generating business, and then we're looking at growth, after that?
So in prefab business, first I will address and then I will come back to margins. Prefab business, the story is following. The business is right now under watch from my side, so management, as well as practically. Practically, it has been swung into a new company, and that's why we need re-rating. And sometimes the re-rating takes 3 years in certain government departments. Certain government departments doesn't want to continue with the order because order was placed in SIL under their SAP system. It is very difficult to change it to a new company, which is Sintex Infra Limited. So we face a lot of headwinds, and new tenders we are not able to get in prefab business, though we don't want to also, but there is a practical difficulty of getting them also. So government business by default it is reducing by headwinds as well as our will to reduce it because of cash flow. Private business definitely is doing very well in prefab. We think because of CSR activity as well as certain projects and labor colonies, we think we will be able to grow this business faster. We have also found out approach to government business which are small, district level or village Gram Panchayat level. Central government wants to spend more money at the root as depth they can get. So village level as well as collectors are getting far more funding than from the state or other institutes. We want to approach this business through our dealers and distributors rather than approaching directly. So we are not saying we are going to completely exit the government business, but we'll be restructuring how we approach that business. All in all, we expect about 2 to 3 quarters of degrowth of this business, and by 19 also government spending will go up because of social infrastructure and 2019 election. we feel there will be positive growth, and from Q4, so about say 1 year from today, we will start seeing prefab business growing again. On this margin business, our circular doesn't show reduction in margin. So I don't understand from where you are coming these numbers. So Samir will address this.
Just to talk about specific numbers, in custom molding, for the last quarter H1 results that we declare, it was 1979 crores top line, and 9 months we have 3015. So this clearly shows higher than the first 2 quarters average revenue. The EBITDA has remained at the same level, which is 15.3, which in fact if you see last year's full year result, not comparable 9 months, it has moved up by probably 20 basis points. So there is a nudge up in the margin compared to last full year. If you want to compare immediate quarters, our revenue has gone up, we have maintained the margins.
Okay, just one more question. On the interest cost, so, we have repaid close to 300 crores of interest, 300 crores of debt so far. But if you look at the quarterly interest rate run rate, it's by and large still at the same level. So, we repaid somewhere close to 260 crores in H1. So just want to understand why is that?
See, sometimes what happens, the utilization, the debt we tell you which is the last day debt. So as of this particular date. But the interest is a period of 90 days, what we used average for 90 days money. And secondly, also the profile of debt sometimes changes. We have international debt which is starting at 1% to 3.5%. And we have local debt also which is somewhere between 9.75 to 11.80 or about 12%. So definitely the amount which debt, if you have reduced international debt, you won't see in interest cost immediately. But our focus is to reduce the cost of borrowing, and our focus is to reduce the debt. And that will continue. We have reduced the debt by 286 crores. Interest also you will come to know soon. Plus interest again is gross interest. So it's the banking interest, receivables, sometimes our suppliers charges us interest. So all those interest put together is the cost of the interest. It's not only financial from banks.
And we had plans to, hello?
Yes, thank you, Mr. Kachari. We'll request you to join the question queue for any follow-ups. Also, participants are requested to limit their question to 2 per participant. Thank you. The next question from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Yeah, good evening, sir.
Good evening.
Hello? Yes, sir. If you could firstly tell us what was the debt level, sir, as on December 17? Our debt level? Hello?
Net debt level is 3,300 crores.
And comparative figure versus the September, quarter on quarter?
Yes, sir. 1 minute. March was 3,600.
And September?
28. 3,628 was March, and now it is 3,331.
And what was for September?
September, I don't have a number right now, but we are talking
These include both the long-term as well as the working capital.
This is total debt.
The total debt. Sir, what is the portion of FCCB that is remaining outstanding as of now? And what kind of dilution can we expect going forward?
Sir, this company doesn't have any FCCB.
That is all in the Sintex industry itself?
Yes.
Okay, so there is no issue with that. And then coming to the promoter stake part also, sir, the promoter stake is assembly at low of 30%, below 30%, with more than 50% being pledged also. So what is the outlook of the promoters when we are expecting good time for the organization? What is the message you want to forward to the investor community in respect of your shareholding?
We will definitely see promoter stake comfortably increasing by about 10 to 11%. And we would like to do it in various methods. We will soon come out with with a proposal. But we feel that before say 1 year from today, promoter would have a stake of close to 40%.
When the March 19 numbers are there, we should be somewhere around 40% from these levels.
Yes.
Okay, sir. And now coming to the point of, sir, we do have some foreign FCCB loans also, I think so. A part of it is there in the, or it is only the rupee-denominated loans, sir?
No, we have ECB. We have a lot of business outside India, so we have ECB loans.
Thank you. Mr. Kapoor will request you to join the question queue for any follow-ups. Thank you. We have the next question from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
Yeah, hi. Good evening, sir. How is our view on our retail side of the business? How was the revenue in this quarter, and how do you see the margin there?
Retail business is the second most earning business for us, and which has a very strong ROC and very strong ROE numbers. Asset is very light, and growth is possible without adding too much of assets. So a very, very attractive business. Plus our brand is very strong recall. So Sintex is very popular for water tanks. We have reconcentrated our efforts to increase retail business. Retail business has done extremely well. Last quarter, we expect even better coming next year as well as Q4. So retail business, we definitely expect 30, 40, 50% growth maybe in Q4 as well as next year. I think we will again be within 3 years taking a hold, or our internal target is to achieve about 35 to 38% market share of water tank business and about 20 to 22% market share of factory-made doors, which currently stands below 15%. So there is a strong push from entire management team to increase retail distributed products, add more products also to the basket, and within 4 years we would definitely make this very, very large business for Sintex BAPL.
And how would be the margin profile there?
The margin has been always historically has been very good, as well as currently also we are clocking somewhere between 15.5% to 18%, depends on the product mix which has been sold in retail segment. If you see yearly average, we would weigh somewhere between 16.5% and 17%. I remind you that retail has very low WIP. So our working capital requirement in retail business is also quite low. Collections are fast, very fast compared to government orders, and raw material stocks and the finished product stocks also are high, but we manage our SKUs in a way that our overall stocks remains low, especially when you have a growth.
Okay, good. Okay, thank you, sir. I will come back in queue.
Thank you.
Thank you. We have the next question from the line of Pawan Kumar from Unifi Capital. Please go ahead.
Sir, can I have the working capital numbers, debtors and inventory position as on December?
Sorry?
Can I have the working capital numbers, debtors and inventory position as on December 17th?
Working capital we may have, but inventory we may not have. But you can ask Rajiv, he will be happy to share within 2-3 days. Working capital.
So, I do not have the working capital numbers right now. Rajiv would note that and probably share with you. But last year's last quarter in September, when we declare, our working capital days were around 61, 62. But if you are so keen on December, Rajiv would get back to you.
But it would be somewhere same, maybe less but not more.
Okay. And secondly, what would be our prefab order book as of now?
It's low. We would be currently at about 450 crores, but the whole order book is not executable. Otherwise, we would have like 3,000 crores. But the orders which we have received from SIL, which cannot be executed right now. And that's why the effective order book would be less than 600 crores.
So, effectively we are saying our order book currently is 600 crores, right, sir?
Yes.
And 3,000 crores, how does it come in as? Because it is the order book of Sintex Industries Limited.
Yes, and it takes a long drawn process to change it. Plus, it is mostly government and our focus have changed. So, currently you can say we have about 6 months order on current run rate.
Okay. And just on the previous participant's question, so on retail, what would be the revenues that we would have done in Q318 in the current quarter?
Our yearly run rate on retail last year was about 600 odd crores, 630, 640 crores. Our target for this year was about 900 crores. And more, but the GST has reduced that target or affected negatively, plus our SAP launch and DMS, dealer management software launch, also affected our target little negatively. We are confident to do it more than 800, 825 crores on year end this year, which is 18 March. 19th again we'll see 35-40% growth.
Thank you, Mr. Kumar. I would request you to join the question queue for any follow-ups. If time permits, you may join the question queue. Thank you. We have the next question from the line of Mohit Khanna from Value Research Stocks. Please go ahead.
Good evening, sir. I just want to come back to the first question. Actually, on the page 4 of the filing done, we have segment-wise consolidated revenue results. In today's filing of page 4, we have these results here, segment results. Now, when we see, try to compare the margins for the custom molding business, which had a revenue of 952 crores in September and it increased to 1,013 crores in December. However, the margin has declined by 160 basis points. So can you just explain what was the real reason here?
So what the segmented result shows is EBIT, EBIT.
Yes.
And what we spoke in one of the question before this was EBITDA. So EBITDA we have maintained. EBIT, at EBIT level there is this gap you are seeing. So and when we talk about margin, we usually always talk about EBITDA, and which has been the trend in all the calls.
Fair enough. But the reason, so is it assumed that the reason for decline in the EBIT margin is the depreciation rate that has gone up?
Exactly, because that is the only I don't have the number, but obviously there is the only explanation, logical explanation at the moment.
All right. So just one more question. What was the cash flow from operations and capex for the quarter?
Cash flow. $589 crores operating profit before working capital change.
And after working capital change?
After working capital change, net cash generation is 423 crores. This is for 9 months. Huh?
Thank you. To the next question from the line of Shubhankar Rocha from SKS Capital and Research. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. I have two questions. So one, this FCCB you said, so say there is some FCCB outstanding at Sintex Plastic level, because I think there has been some communication to the exchange. Like I can see the announcement on 30th of November.
Can I explain this?
Yes, please.
FCCB was issued when two companies were together. SIL was having all the divisions, and then we split. So when FCCB is getting converted, the FCCB holder gets both the shares,
Right.
SPTL as well as SIL, and that's why you see all these announcements on the stock exchange.
Correct.
But if you ask me debt profile and how much debt is pending because of FCCB, well, that is not SPTL subject because SPTL has no debt from FCCB. It is only in SIL.
No, so in terms of you'll have to dilute. I mean, what will be the fully diluted share outstanding? That is what my question is.
So to answer that, outstanding FCCB as of date is $18.5 million in the books of SIL. When it will get converted, it will get appropriated shares from SPTL as well as SIL. And fully diluted equity in SIL and SPTL will be 60.4 crore shares.
So post entirely, that happens, the promoter holding is likely to go further down, right? I mean,
marginal. Now it is not 18 million is nothing left. Huh?
Got it. That is one. So secondly, you said 10% of equity, the promoter has the intention to go up to 40% by the end of March 19. So is there any? Is there routes or the options that you can give us now or?
No, we will come out with the proper plan. It depends on promoter cash flow. It also depends on what kind of a market situation is, plus also legality. So we have already approached merchant bankers to guide us through, and definitely we'll come out with the proposal, and then we'll talk about it maybe in the next call or before that.
Okay, great. And sir, can you share this number, the capex number for 9 months? You share the cash flow from operations.
We had benchmarked ourselves this year, that we want to control it below 200 crores on local operation and about 50 crores for international. Currently at SPTL level, we are at 150 crores, which is extremely strong. This includes international capex, local capex, our acquisition internationally also includes SPTL and Sintex Infra. So it includes everything. And we are at 150 crores or less.
Thank you. Mr. Oja would request to join the question queue for any follow-ups. Thank you. We have the next question from the line of Sachi Seksaria from Value Investment. Please go ahead.
Hi, thank you for taking my question. You spoke about the customs molding business being strong. I just want to get a sense of what kind of growth rates are you seeing here and how do you see that evolving into 2018?
2018 is almost over for us. So 18-19 we see a strong growth. I see Europe as reviving. We are going to see a strong European economy in coming years. And we have also seen a strong aerospace and defense business again. After many years, defense spending and aerospace spending has gone up. So Europe looks very strong. Last year we had a strong growth in Europe and a very healthy margin, and we'll continue to grow even stronger. Locally, we are very bullish about automotive industry. We are also very bullish on businesses like retail and electrical. We expect the India business to do about 20%. International should do about 10%.
Okay. And just I wanted to get a sense of what is the sort of margin difference that you see internationally and India, which could be higher?
Obviously, Indian EBITDA margins are higher than international margin. Internationally, we are running close to 11.6%, and India we are running at about 18.5%. But when you look at net levels, they are almost same. So because India is high on interest cost and high on depreciation, internationally is low. So net level margin we don't see much difference, but EBITDA levels, yes, there is a difference.
Thank you.
Thank you. We have the next question from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir, for the opportunity. So first, on the debt level, you have mentioned that our focus is on to repay our debt, and we have already paid 300 crores till 9 months. So what kind of debt targets we have by FY18 end and FY19 end?
So we are currently at 3,300 crores of debt, and we currently have a EBITDA of say 850,000 crores. So our target is to be below 2. Now here we need to see dynamically. Next year we expect increase in our EBITDA margin, and obviously we want to reduce our debt. So till the time we don't cross this benchmark of EBITDA to debt at 2, we don't want to do any new large capex or acquisition. Once we reach this target, then we'll be more aggressive for the growth. For our retail business and international business is not asset heavy as of now. We have a room to grow. For local custom molding business, we'll hit a capex cycle of 2020, where we would like and come back and say that yes, we want to spend 150 crore more on our local capex than what is our target, which is 200 crores. So till that time, I don't think that you will see any larger number than 250 crores, 200 locally, 50 internationally. So we should be somewhere there.
Yes, that I'm aware of, that we are looking at 250 crores of sustaining capex. But I was more asking in terms of absolute numbers. What is the level that you are looking at by FY?
It doesn't justify to have an absolute number target, and I personally don't have it. It definitely depends on your profitability. So if the business is profitable, say you are doing 1,500 crores, you can easily maintain 3,000 crore of debt. So it depends on the kind of money the business is generating and sustaining the debt. Interest could be any. Interest could be lower or higher, but sustained debt for me to do a large capex is 2:1.
Right. But given the cash flows and margin improvement we are talking about, at least 300 to 400 crores of debt repayment again next year is what is a possibility?
No, 100%. I would be really unhappy if we do less than 300 repayment.
Okay, understood. And so you mentioned on your custom molding, we are looking at 20% growth in domestic and 10% growth in overseas. Now, given your overseas forms a larger portion of your overall custom business, so custom overall may grow by about maybe 13, 14, 15% kind of level. And prefab anyways, we are talking about degrowth. So overall, what next year 10 to 15% kind of revenue growth is what we are looking at?
So first of all, our international business is not so great, not so large now. It's 50-50 almost. And next year we expect 60-40. So 60% India and 40% international.
Okay.
Second, yes, we expect large retail market. So custom molding business, India will grow about 20%, international will grow about 10%, and that depends if euro is helping us, euro-rupee relationship helping us or not. But retail business, definitely we look at much higher number here. And yes, degrowth on the prefab business is not going to be that drastic that what we have seen this year.
Okay.
So overall, I would safely assume we should do more than 18 to 22%.
22% revenue growth is what we are talking about overall.
18 to 22%. Depends the mix on SBUs.
Right. That's overall consolidated revenue growth that we are talking about, right?
Yes.
Thank you. Mr. Poddar, would request you to join the question queue for any follow-ups. Also, ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to one per participant. Thank you. We have the next question from the line of Ashwin as an individual investor. Please go ahead.
Thank you for taking my question. Coming back to the numbers, Amit, I think last time on the con call you said roughly in H1, custom molding had grown by 400 crores. If I understand that right, then H1 FY17 was about 1600 crores, whereas H1 FY18 was about 2000 crores for custom molding. First, let me just make sure that this is correct. This understanding is correct.
No. This it's not correct. So we need to figure out how
Because it was mentioned on the last con call. Anyway, linked to that, I have another question because again, we are getting different numbers. I had written to investor relations and then we had got retail FY17 as about 25% of 4,000 crores, which is about 1,000 crores. And today I'm hearing close to 600 crores. So it would just be helpful. Maybe we can't resolve it on the call now, but it would just be helpful if you can share these split up between the three divisions of custom molding in one, standardized format. Is that possible?
No, that is very easy explanation. The retail business has been redefined twice. One, which is as per our SBU, internal SBU, and second through distribution channel. So both numbers are right. When we distribute our products on retail segment, we talk about only two products, which is our factory-made doors and water tanks. When we talk about retail distribution channel, so DMS, entire dealer network and their sales, it's 1,000 crores. That includes also large tanks which our dealers are supplying to institutes. But that comes through a different vertical as far as our internal subjects are concerned. So literally retail means small household, one tank orders. That is for us retail. And that is about last year 600 odd crores, 640, and this year we expect about 850 crores. The retail segment or retail distribution segment, which is about 1,000 crore last year and this year could be 1,200 or odd number, which no more exists, we don't consider ourselves there. That includes also large products, large tanks which our dealer sold to institutes. Now that is been hived off into a different vertical.
On this retail business itself, you've talked about in the past as well, a lot of transformation ideas or, levers that, you're going through across the supply chain. Would you be able to talk about the top three which will, drive growth in the next, 3 to 4 quarters?
Sure, Samir will be able to address this better.
If you want to list three, so there are many as such, but if you want to list three, distribution network expansion, focus on retailers and influencers, which generally is called secondary sales in the trade, and third is new product development, which are the three primary focus which we have. And there are many other things along with it, but I probably would restrict my answer to that.
Thank you. We have the next question from the line of Milan Desai from India Infoline. Please go ahead.
Thank you for taking my question. I just want to understand the split up of quarters in terms of custom molding business, right? So right now we have seen different numbers. Just to gauge the future performance, what is the weightage of the fourth quarter? So how heavy does it get? And as far as there were certain exceptional items, right? So if I remove the stamp duty from the last quarter, you had also mentioned that there was like about 100 crores, 50 crores you had mentioned that pertaining to SAP, right? So if I were to adjust that in our quarterly numbers for the last quarter, which is 2Q, our margin is about 17% overall. So is this a correct way to look at it? And so if I look at it, I think there is still some lack of clarity in terms of margin, if you can elaborate on.
No, that is a correct way of looking. We should actually remove one-time expense from both the quarters and then compare both the quarters. That is the best way to do it.
Is there something exceptional this quarter as well? That's what I want to know.
No, there is no exceptional this quarter. Only last quarter.
The only thing is the exceptional item about stamp duty you are talking about, it is below EBITDA. So anyway, it was not in EBITDA earlier, and so you shouldn't consider it.
So no, but the SAP cost you had mentioned.
That you should, yes.
Thank you, Mr. Desai. I would request you to join the question queue for any follow-ups. Thank you. The next question from the line of Nalin Ladewala from Tata AIF Life Insurance. Please go ahead.
Thank you for taking my question, gentlemen. Sorry, I'm just persisting on the custom molding business. When I see the consolidated results, I see depreciation is broadly flat at 60 crores. And also segmentally, EBIT for custom moldings has declined by 9 crores quarter on quarter, and which you explained as entirely because of below the EBITDA line items. So I'm failing to reconcile. If you can just help me understand.
Yeah, as I just mentioned in a call, in the same call little earlier, our EBITDA has remained the same. In fact, in a very the second digit of decimal, it has improved. In fact, this quarter. Okay. So if we look at EBITDA level, we have done better. All right. But if we look at EBIT level, which we are focusing, the custom molding is lesser, and so as Amit also explained just now, we actually don't have the depreciation number for both segments separately right now. But even our take is that it should be because of depreciation, because that's the only difference between the two.
Yes, because at least if I look at the consolidated numbers, depreciation is flat quarter on quarter. So I am at loss why there should be such a substantial movement in depreciation in one segment and just the reverse in the other segment for us to be able to explain this kind of a divergence. It will be pretty important, sir. I mean, if you can just explain.
So what we would do is once the call is over, Rajiv Naidu would share the numbers of depreciation specifically so that you know the difference, right?
Thank you. We have the next question from the line of Akshay Ajmera from Nirzar Securities. Please go ahead.
Yeah, hi sir. My first question is, what is our total ECB loan? If you could quantify that, please. Hello.
$55 million US.
$55 million US. Okay. And sir, my second question is, could you please repeat the margin numbers segment-wise, because I missed on that. What was it in September quarter and what was it now for custom molding and prefab division? EBITDA margin?
We didn't spoke about that today in the call, but Samir will give you.
Yes, so I will give quarter 3 EBITDA margins. Custom molding is at 15.2 and 2%, 15.2%, and prefab is at 13.2%.
Prefab is?
Sorry?
Prefab is how much, sir?
13.2.
Thank you. We have the next question from the line of Asim Bade from IDFC Securities. Please go ahead.
Hi sir, just one question. Any comments on your recent board resolution of that 1,800 crore fundraising that you had put up on the BSE recently?
Yes, we have signed a definite agreement with KKR. The idea is to reduce interest cost and improve liquidity and postpone the repayments. So the idea is to increase our average maturity from 3.2 years to 7.8 years. Also, the idea is to reduce interest cost on absolute amount by about 150 basis point, 1.5%. The deal is not closed yet. We are actually halfly it is closed, halfly it is going on. So maybe within next few days, maybe next 2 weeks, we'll close it completely. We are not legally supposed to inform stock exchange, but we will try to circulate once the entire deal is closed.
Okay, thanks.
Thank you. With a follow-up question from the line of Milan Desai from IIFL. Please go ahead.
Yes, sir. I just wanted to understand the relevance of the fourth quarter, like in terms of weightage, if you can share some information on that.
Yes. See, in prefab business, definitely there is a fourth quarter is stronger. But on custom molding business, it's better than the third quarter internationally. Locally, almost same. So there is there is not much difference. So if you see custom molding business, I would say about 2 to 5% heavier Q4 always than Q3, average of Q1 to 3. And internationally, yes, Q4 is heavy because Q3 is low because of the December and the holidays it gets. So that's the reason why Q4 is always about 10% higher internationally from Q3.
Okay, and sir, I'll just follow up on the earlier question. So just depreciation, you will be sharing information, right?
Yeah. So we have depreciation consolidated, but it looks same. But still there is a difference between EBITDA and EBIT. So actually we'll find out the entire reason and share it with all. And also depreciation number separately. It has to be depreciation, nothing else.
Okay, sir. Thank you.
Thank you. We have the next question from the line of Sameer Dalal from Natwarlal & Sons. Please go ahead.
Thanks. My question is,
Mr. Sameer, the audio is breaking, sir. May I request you to use a handset?
Yeah, now can you hear clearly?
Yes, sir. Please go ahead.
Yeah. So my question is in regards to the prefab business, where you're saying you had orders of 3,000 crores, but because of the split in the company, now your order book only really stands at 600 crores. So the first part of the question is, cannot Sintex Plastics complete those orders through Sintex Industries as a vendor and try to get the revenue and profit from those orders? And two, you also mentioned that it could take up to 3 years to get empaneled again for a lot of these government orders. Given that this would have been a problem, it kind of affects the profitability, because of which I'm guessing your margins are down because utilizations are down. So what is the steps you are taking to improve the profitability of that business and getting the business back for the prefab business, which was growing very aggressively in the past?
So there are multiple reasons of degrowth in prefab business. First, our own will to degrow and exit government business because it's heavy on balance sheet and payments are getting tougher after demonetization. So, one, we have decided that we want to slowly and steadily reduce the governments or the companies belongs to the government who pays us not on time and demands too high performance guarantee, bank guarantees for 2 years, 5 years, 10 years, which increase our liabilities. So that is at our will. Second, yes, we had a large order book from SIL. I can execute from SIL, but that is not what we are going to do it. We have earmarked that we want minimal exchanges between these two listed companies, and we try to curtail this order book. Otherwise, it will go, the same outstanding will go in SIL book, and which we did not wanted that. Third, slowly the business profile is also changing. We are coming out with the products which are more suitable for CSR activity as well as from private large corporates, and so we are very confident that within third quarter of next year, which is December quarter, I think prefab business will start growing positively. And fourth question was about the margin. Once we hit good utilization on prefab business, the margin will come automatically. We have not driven our prices down. It's very complex product, very high service levels are required, and there are very few competition. So definitely the product has a very high margin potentiality, which we will start seeing coming from less working capital intense customers.
Okay, so can you just last thing specify what was the utilization for the prefab business?
See, the best we did was about 2,200 to 2,400 crores sales. That was our peak, and that would be at about somewhere 78%, 75% utilization. So you can say that easily we can do 3,000 crores of prefab business or Sintex infra business. currently, obviously it is not that, and we must be running less than 50%. And next year projected is almost same or maybe 5% less, so say 45%. And there at that levels, you don't make a 22-24% EBITDA.
Great, thank you.
Thank you. Ladies and gentlemen, we'll take our last question. That's from the line of Pawan Kumar from Unifi Capital. Please
about the money raising of 1800 crores. So that money would be used to repay the existing debt, and it will help us lower our interest cost. Is that the idea?
Yes, lowering in 100% it is going for repayment, no other expenses. So all the debt raised will go for debt repayment. The interest rate reduction, yes, one thing. Second thing, improving cash flow. We will be pushing our average maturity from around 3.5 years to more than 7 years.
Okay. And lastly, on the custom moldings business and also the prefab business, what is the kind of overall degrowth we are looking at the current year? I understand we are expecting very good outlook on the next year, though.
Custom molding business, we are not looking at degrowth, we are looking at the growth. And all business looks very strong other than prefab. So prefab, we are looking at a degrowth from last year.
Okay, so last year, how much was it, sir? And this year, what can be our estimation for the complete year?
Last year was about 2,050 was the last year.
Okay.
And this year, this quarter is about 300.
Okay, should we assume the same kind of run rate even in Q4, at least for this business?
Yeah, so we assume about the same 300 crores in Q4. And I think the lowest we will see is about the next Q1, which will be, say, 250. Then slowly it will start picking up. And Q4 again, we will see more than 400. So that's what we think.
Okay.
So basically, this year and next year will be almost same or maybe a little less.
Fine, sir. Got it. Thanks.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you, sir.
I would like to thank everyone to participate. We would definitely share the depreciation numbers with all, and Rajiv would be happy to address any more questions if you have. Thank you.